Hello everyone, I welcome you back from the previous video where I had discussed the theory aspects of IAS 23, and towards the end I had said that we'll be discussing the questions in separate video. So today I will be discussing with you 5 exam style questions on IAS 23. As always, you should try to do these questions on your own before watching the video, but it's all up to you if you wish to see the solution first before trying on your own. So let's begin. Which two of the following statements about IAS 23 borrowing costs are correct? So we have been provided with 5 statements, and let's try to read them one by one to see which of these are correct. And notice how we have to select 2 of them. Borrowing costs must be capitalized if they are directly related to the qualifying assets. This is true. Remember, in the last session we had talked about that for a borrowing cost for a particular asset to be capitalized, the asset must be a qualifying asset, which means it should take substantial amount of time to get ready. So if it's a qualifying asset, then IAS 23 can apply if you take out the loan for the construction, acquisition or manufacturing of that particular asset. Statement B. Borrowing costs should stop being capitalized once the asset is substantially complete. This is true. Once the asset is substantially complete under context of IAS 23, it means when the asset is ready for its intended use, then you should stop capitalizing, and this is true. Substantially complete means when the asset is ready for its intended use, you should stop capitalizing. This is true. So statement B is also true. So we have got our answer, but for the purposes of understanding, let's go through the other statements as well. Borrowing costs must be capitalized if they are directly linked to non-current assets. This is false, because that non-current asset must be a qualifying asset. Okay. Borrowing cost may be capitalized if they are directly related to the qualifying assets. Notice how it is different from statement A just because of this word. It says maybe, but it says must be. You don't have a maybe situation in borrowing cost when it comes to qualifying assets. You have to capitalize it. So D is not true either. Borrowing cost should begin to capitalized once the expenditure on the construction of the asset starts. Now this is true. This is a point. This is true. So why did we not select E? Because remember, in the previous session I had told you there are 3 conditions related to the borrowing cost that must be met. One of that condition is the expenditure on the construction of the asset that should start. It is true, but there are 2 other conditions as well. Condition number 2 is that the borrowing cost must be incurred. Okay, the borrowing cost must be incurred, and number 2 is that the activities to construct the asset must begin. So these are the 2 other conditions. Construct the asset must begin. These are the 2 other conditions that must be met along with the condition which is already given in the statement. So all 3 of these must be met for the borrowing cost to be capitalized. So it is not limited to only one condition. So that is why E is not our option. I hope this is clear, and this might have cleared a lot of points and would also have helped you to revise IAS 23. Let's move to question number 2. Okay. To the nearest 1,000, how much borrowing cost should be capitalized? So we have to calculate borrowing cost here. Let's read the question slowly. An entity had a $1 million loan at a 6% interest. So this is one section of the loan information, and it also had a 2 million loan at a 9% interest. So it was having 2 loans at 2 different interest rates, okay, throughout the year. It used these existing loans to fund the construction of a new factory costing $600,000, which took 8 months to complete. Notice how they used existing loan. They did not take out a specific loan to finance the construction of the asset. They used the existing loan. And that factory costed $600,000, which means from the total loan, they would have taken out $600,000 and they would have used that to fund the construction of the asset, which took 8 months to complete. we have to calculate the borrowing cost. Now, one hint that I will give you, whenever the question is going to mention existing loan, it usually means and definitely means journal borrowings. It means journal borrowings, okay? And when it comes to journal borrowings, we have to calculate what we call as weighted average interest cost. Okay, we have to calculate that because we essentially do not know how much interest rate is specifically going to go on 600,000. The reason why is because look at here. If we have this pool of funds, we have funds from 1 million loan, okay, and we have a 2 million. All of this is combined together. So in a pool, they are all mixed up. When, for example, the manager came and they talked about that we want a loan to construct the asset, what the treasury department must have done is they would have taken out how much, 600,000 out of this pool. Now out of the 600,000, how can we know that how much of the 600,000 belongs to the 1 million loan and how much of the 600,000 belongs to the 2 million loan? So we cannot attribute a specific interest rate to the 600,000. That is why we calculate an average cost of interest using the information about the existing loans that is already given to us. I will show you how we calculate the weighted average cost. So you will work it in this way. Weighted average cost of interest. So what you will do is you will write down the loan amount. This is the interest percentage and this is essentially going to be the interest. So how much is the first loan? It is 1 million. Okay, or let's just put this here in dollar million and dollar million. Let's just make it easier. So how much is the loan? 1 million loan. What is the interest rate? 6%. So can you tell me annually on 1 million loan, how much interest do we have to pay? Well, we have to pay $0.06 million. How did I calculate this? By simply taking 6% of the 1 million loan. So essentially 6% of 1 million loan will tell you how much annual interest we have to pay on 1 million loan. Then on 2 million loan, we have an interest rate of 9%. Can you tell me how much is the annual interest that we have to pay? It is going to be 0.09 multiplied by 2 million. This gives us 0.18 million is the interest that we have to pay. Now what you will do is you will add these two interest amount. So you will add 0.018 plus 0.06, which is going to give you 0.24 million. This is essentially the total interest amount and annual total interest amount which you have to pay on the total amount of loan which you have borrowed. Okay. Now what you will do in order to calculate the average interest rate, what you will do is you will simply take the 0.24, which is the total interest, divide this by the total loan amount, which is 3 million. So if I give you the formula, this will simply be the total interest cost divided by the total loan which the company has taken as part of existing loan. Okay, so once you do this, you divide and then you have to multiply this by 100, because what we are essentially trying to do is that we are trying to calculate the average interest percentage. Okay, so once you do this, put this into your calculator, you should find out that the interest rate is going to be 8%. Now this is the average interest rate we have got, which we now can apply on the amount which we have borrowed from the pool of funds. Then what you will do is you will calculate the borrowing cost. In order to calculate the borrowing cost on the loan which is used to fund the construction of the asset, you will take the interest cost, which is 8%, multiplied by the amount which has been borrowed from the pool of funds, which was 600,000 here. This was the amount 600,000 which will be used to fund the construction of the asset. Once you take the 8% of 600,000, you should find out that the borrowing cost is going to be 48,000. So the borrowing cost comes out to be 48,000. But I'll stop you here now. You might think this is the answer and we are done. No. Now notice these interest percentages, when they are applied to the loan amount, they are going to give you the interest cost for the full year, right? But in the question it says that it took 8 months to complete, which means that we are only going to be capitalizing the interest cost of only 8 months, because as soon as the construction stops, you will stop capitalizing. So therefore the borrowing cost that will be capitalized will be 32,000. All right, you have to be careful about these months and date periods, because you can easily mess up. It's very easy for the students to mess up if they miss important information such as dates and the months period, because you have to ensure that you're capitalizing for the right amount of time. Okay, now let's move to question 2. Sorry, this is question 3, which is looking slightly complex in nature. But let's see how IAS 23 is applied in this context. Let's read the question. Calculate the borrowing cost that can be capitalized for this project for the year ending 31st December 2008. What I will do, I will draw the timeline. 31st December 2008. So my year must have started on 1st of January of 2008. Okay. A company had the following bank loans throughout the entire year. 15 million at 9% interest, okay, maturing in 2009, so somewhere in the next year. 24 million at 11% interest, maturing in few years time. These loans were part of the company's journal borrowings for the year. This is very important that we are dealing with journal borrowings. The company started building a qualifying asset on 1st of April 2008. So means somewhere around here, it started constructing a qualifying asset. And to finance the construction, it withdrew 6 million on that date. So what event occurred here? It withdrew how much? It withdrew 6 million from its journal borrowings to finance the construction. Later on 1st of August 2008, an additional 2 million was withdrawn for the same purpose. So somewhere around here on 1st of August 2008, it withdrew an additional amount of 2 million for the same purpose, which was the construction. You have to calculate the borrowing cost. Now, I will give you one tip. No matter how much it withdrew, at whatever point in time of the year, the very first thing you should do is to calculate the weighted average cost of interest. That is the most important thing we should be having in order to calculate the borrowing cost, because this is journal borrowings. The question already told us. Stop the video right here and try to calculate the borrowing cost on journal borrowings. I want you to calculate this before you play the video and try to see the remaining solution. So stop and try to do this on your own first. Okay, if you did this, that's great. If you have not, then this is how it will be calculated. What is the first step? Let's calculate the weighted average cost of interest. So I'm going to write this heading down for you, weighted average cost of interest. And what you will do is, you will simply make a table, but of course in the exam you will work more quickly, so it's completely fine if you skip doing this. So loan and interest, you have 15 million of loan, work it in dollar and million. Okay, hopefully you're understanding what I'm doing. And you have a 9% interest. Then you have a 24 million loan who has a 11% of interest. So let's put some calculations here. What is the total amount of loan? 15 plus 24 gives you 39. And what is going to be the interest now? So 9% of 15 is 1.35. This is annual interest, okay? And 11% of 24 will give you 2.64. Once you add 2.64 with 1.35, you should find out that it comes out to be 3.99. And therefore, the percentage interest is simply going to be the total interest amount, which is 3.99, divided by total loan amount, which is 39. Multiply this by 100. 3.99 divided by 39 into 100 gives you 10.23%. Okay, once we have got this strong information, let's just try to work through the timeline to see how will we be calculating the borrowing cost on the loan amount which has been used to construct the asset. So what you will do is, first you will be calculating, I will show you from this point Okay, from 1st of April, we'll be working all the way till 31st of December. Okay, because that much amount of loan is still being used to construct the asset up until the year end. So that's that. Number one, let's just try to solve it now. So what you will do is, secondly, here on 1st of April 2008 up until 31st of December. First tell me how many months does that make? Now let's count together. April, May, June, July, August, September, October, November, December. That makes it 9 months. So what you will do then, you will take the 10.23%. Oops, I'm running out of space. Okay, I will try to squeeze in. Okay, bear with me. 10.23%, which is the interest rate, sorry. 10.23%. Multiply this by the loan amount. How much is 6 million? Once you do this, once you calculate this, you should find out that the annual interest on 6 million will be $0.614 million. Okay, then you will divide this by 12 to calculate the interest per month, multiply by 9 months, because that loan is going to be for 9 months up until the year end. You should find out that the borrowing cost is going to be 0.46 million. You will do what you will do now in third case. I'm sorry, I'm squeezing, but I'll try my best to explain you properly. You will now work with the 2 million amount from this point all the way to this point. Okay, so what you will do is, you will do the similar thing. How many months does that make? August, September, October, November, December. That makes 5 months. So we are going to be working with 5 months in a very similar way. What you will do is, you will calculate the 10.23% on what amount? On 2 million, here on 2 million, and then this should give you the annual interest charge of how much? Of 0.205. Then you will divide this by 12, because we are only going to be working for a period of 5 months. Then you will divide by 12, multiply by 5. This should give you 0.085 million. Now do one thing for me. Take this and you're going to add this amount, and you're going to add this amount in order to calculate the total borrowing cost. So can we add these two values together? And once you do this, you should find out it comes out to be 0.545. And if you calculate this in millions, you should find out it comes out to be 545250. This in millions is this comes out to be 545250, because this is essentially millions, right? So once you convert this into full form, you will come to know that this is the amount. But because the answer we have got is close to the option number A, which is the first point, then we'll be selecting the first answer. The last one you could argue is also close, but it is far away. Technically, if you see, it's very far away. So the only difference here is just a few thousands of difference, because you see it's 549 here and this is 545. So the difference is likely because of the rounding off. Okay, so you'll find the closest one to the option that you have. Now let's go to exam question number 4. Let's see, calculate the borrowing cost that can be capitalized for the year ending 31st December 2009 for this project. A company borrowed 2.4 million loan to fund the construction of the factory. This is important, so let's just highlight this. What did they end up doing? They borrowed 2.4 million, which is expected to take 2 years. Now, this construction is expected to take 2 years, so that makes it a qualifying asset, because it is taking substantial amount of time to get ready. Qualifying asset. The loan was received on 1st of January 2009 and construction began on 1st of March 2009. Now these are very important dates. We are going to be talking about them now. Out of the total loan, 1 million was not used until 1st of July 2009, allowing the company to invest this unused portion until needed. The company pays 8% interest on the loan and can earn 6% by investing surplus funds. We are supposed to calculate the borrowing cost. This is a very interesting question and it is going to cover a lot of concepts here. It is going to cover many areas of IAS 23. For this purpose, first of all, we are going to draw the timeline. So, extending it all the way to 31st of December of 2009. A year must have started on 1st of January 2009. Let's see. The loan was received on 1st January, right? But the construction began on 1st of March. Now, this is important because even if the loan was received, the construction began on a later date. So, the capitalization must start when the activities necessary to construct the asset incur, expenditure on the asset begin, and the borrowing cost begin to incur. Do you remember the three conditions? They must all be applied for the borrowing cost capitalization to begin. So the capitalization will start on 1st of March 2009 on this particular date. It's extremely important. So what I will do is I will write that the capitalization begins so that I can understand what to do. Okay. So how much was the total loan capitalization of what should begin? 2.4 million, technically of 2.4 million as of now. Okay. But out of the total loan, 1 million was not used until 1st of July. So if we take out 1 million and till 1st of July it was not used, means up until this point it was not used. So which means how much loan was used then? 1.4 million. And what was happening to the remaining 1 million? The remaining 1 million was invested until this portion was used. So on 1st of July, we started using the 1 million loan amount. Till that point, up until this period, there was an investment period. That 1 million was invested. Okay, that 1 million was invested. So this is a very important timeline which we will have to account for. What I will do is I will try to highlight this, that we had an investment period. And then what happened? Then on 1st of July we begin using that 1 million for the construction of the asset. Now what we are supposed to do? We are supposed to calculate the borrowing cost. Now what kind of loan is it? Is it general borrowing or is it specific loan? In this situation it is a specific loan because the statement says that the company borrowed this much amount to fund the construction. So it is very specific to the construction of the asset. So thank God we don't have to worry about weighted average cost. But let's see what we will do. Now one of the most important things to understand here is that even though that we did not use 1 million loan up until 1st of July, you must understand that the borrowing cost capitalization criteria would have started on 1st of March of 2009. So when we were talking about 1st of March 2009, we would have talked about the entire 2.4 million of loan on which we would be accounting for the interest. Okay, because see, we took out a 2.4 million loan, right? Now the loan provider does not know what we are going to do with that loan. It is our decision that we are going to use half portion now and the remaining portion later, but the borrowing cost on the entire loan amount would still be charged as normal. Okay, so on 1st of March 2009, the 2.4 million borrowing cost would have been charged from 1st of March all the way to 31st of December 2009. So what you will do is you will first calculate the borrowing cost on 2.4 million. So it would have made 2.4 million multiplied by how much is the interest cost? It's 0.08, and you will divide this by 12 because we have some months to account for because it's not for a full year. So how many months does that make from 1st of March all the way to 31st December? So March, April, May, June, July, August, September, October, November, December. It makes 10 months. So you will calculate the borrowing cost for those 10 months, which should give you 160,000. Okay. Now this is the borrowing cost which we are going to be incurring on that particular loan. Now, then what happens is we also had the investment income for that particular amount. We will be deducting any investment income. So what is going to be the investment income here? It is simply going to be 1 million multiplied by how much we could earn, 6%. Okay, and then for how many months had we invested for? From 1st of March to 1st of July, it makes March, April, May, June. That makes it 4 months. So once we calculate that, you should find out that the answer is 20,000. So 20,000 is your investment income. you will net these two amounts, and what will be your net interest expense? Your net interest expense will be 140,000. Therefore, the option is going to be A, the first option, which is going to be 140,000. So the most important thing to understand here is that the borrowing cost on full amount of 2.4 million were qualifying for the capitalization on 1st of March 2009. It was only at that point that we decided we have some investment income, we'll be netting that off in order to calculate the net interest expense. Okay, because if we go back to the three criteria, the IAS 23 states that the borrowing cost must incur. So on 1st of March, borrowing costs were being incurred. Activities necessary to construct the asset are being incurred. Yes, because the construction began on 1st of March 2009. And if the construction began, then it means the expenditure on that asset was also being incurred. So the capitalization of the borrowing cost began. Notice IAS 23 conditions were not that the loan that you have taken out must be used on that asset for the borrowing cost to be capitalized. That is the reason why we also accounted for the full capitalization up until 31st of December, even though 1 million of the portion was not being used for about 4 months, but we took the borrowing cost for the full 10 months and we simply netted with the investment income of the 4 months, and that is why we calculated it in this manner. Okay, hopefully this is clear. If not, let me know in the comment section below and I'll try my best to explain you again. Now moving to exam question 5. This question is a homework for you. Do it yourself. Let me know in the comment section below if you have got it right. I'll check this answer specifically for you and will tell you if you have done something wrong or if you have done it all right. In the next video, I'm going to start with the new standard because this standard is now finally over. So I will see you there. Till then, take care and have a nice day, and don't forget to do this question, okay? I want to see your answers, so make sure you do post them in the comment section